Loblaw recently reported earnings, and let's go over how they look, what they mean for the stock, and if it's a good buy right now. Q1 ended on March 22nd, and the company's sales totaled $14.1 billion, which was an increase of 4.1% year over year. What was of key importance was its same-store sales growth rate in its food business. That was up 2.2%. Same-store numbers tell you its organic growth, how well its operations are growing when comparing just the stores that were open a year ago. So it excludes the impact of any new locations or acquisitions. At 2.2%, that's a decent rate of growth for a grocery retailer. What was also solid was Loblaw's net earnings, which totaled $503 million. That was up nearly 10%. It was a good quarter overall, but what about the outlook? What does Loblaw see ahead? Despite the uncertainty with tariffs and a trade war with the US, Loblaw still expects its adjusted EPS to grow in the high single digits this year. That's a good sign. The company has some exposure to tariffs, but it can adjust supply and focus on more Canadian-made products in order to adapt, and it could also raise prices. And even if the economy is under worse conditions, people still have to eat, they still have to buy groceries. That's why Loblaw is what you'd call a good defensive stock. It's a fairly safe investment to hang on to, even if the market may not be in such great shape. And that's why while you may have been seeing the markets crash in the US, Loblaw stock is actually up 18% this year. It's been doing more than just fine. One thing that's helping Loblaw these days is the Buy Canadian movement, with many consumers focusing on local products and supporting local stores as a way to help the economy and not support American-made products in American stores. But Loblaw's CEO isn't convinced this trend is going to last. While the company has been highlighting domestic products and making it easier for consumers to find Canadian products, he believes that it will ultimately come down to price and quality. And while supporting Canadian products may be ideal, if it costs a lot more to do so, it can be difficult for that trend to stick. But regardless of what consumers are buying, Loblaw is likely going to pass on price increases due to tariffs on its customers. So it's not going to be a huge issue for the company one way or the other. As long as they're spending their money, the grocer is going to be just fine. It obviously sells more than just groceries though, and a decline in any type of discretionary spending could still be problematic for Loblaw. That said, because it's primarily in the grocery business, it's going to be in a bit of a safer position than other retailers will be. Now let's take a closer look at the stock itself. As mentioned, it's been doing well, but here's one thing I don't like about it. It's trading at 32 times its trailing earnings. That's well above its 5-year average of less than 22. You can see there was a big spike in value this year, likely due to investors looking for safe investments to hide into due to the tariff risk. And Loblaw hit a lot of those check marks off for investors. It's safe, it's not a volatile investment, and it even pays a dividend that yields right around 1%. The problem with buying a stock at a high valuation, however, is that it may be due for a decline later on. Paying more than 30 times earnings for a retailer which is generating just modest growth doesn't look like a great option. The stock is trading not just at a 52-week high, but also an all-time high. You'd have to be very bullish about its growth prospects to believe that it's still a good buy at this level. People are hiding out in the stock for safety, but I don't think that's going to last for long. At some point, worries about the valuation are going to kick in. There are also many other high-yielding stocks out there to choose from than Loblaw that pay much more than just 1% in dividends. At such a low yield, you'd have to invest 6 figures to collect $1,000 in dividends per year. It's just not much of a compelling buy right now. If you want a safe investment, go with something like the Vanguard FTSE Canadian High Dividend Yield ETF. It pays 4%. Another option is the iShares Canadian Select Dividend Index. It pays around 4.3%. Loblaw's business should be just fine, but there's nothing terribly exciting to make this stock a must buy right now, or to justify its high valuation. So while it did do well this past quarter, I wouldn't rush out to buy it. There are better options out there.